This week on the Gray Report, federal regulators have adopted a new policy statement on prudent commercial real estate loan accommodations and workouts. Is this the extended pretend we have all called for? Is this in response to the latest report on loan maturities and distress in the multifamily market released by Gray Capital? Welcome to the Gray Report. I'm your host, Spencer Gray. If you're a multifamily investor, active, passive, somewhere in the middle, or someone that's just been in the industry for years, well, this is the one show podcast or YouTube designed especially for you to keep you up to date, up to speed with all of the latest and best information, helping you to have a really clear vision of what's going on in the industry, in the market. And if you're an investor, it's going to help you make some really well-informed investing decisions. A great deck of reports today. A piece from the Federal Reserve Bank of the United States. Not sure if you've heard of them. Talking about upcoming conditions, as well as a release of their minutes from the last FOMC meeting. A national rent report from Apartment List taking a look at, are we trending in the right direction? Are things still flat? Or do we have trouble up ahead? And we also have a really interesting piece from Cushman & Wakefield titled The Glide Path Report. What is that? It's an interesting title. It's about capital markets, which is a really crux of making any deal work in today's market. So critical piece of information. Well, Dr. Matt Bosnagel and myself are going to be breaking it down, giving you some original commentary. So stick around for the full episode. Let's get into it. Welcome back to the report. Joined by Dr. Matt Bosnagel, Director of Communications here at Gray Capital. Again, my name is Spencer Gray. I'm the President and CEO of Gray Capital. We're a multifamily private equity real estate investment shop based out of Indianapolis, Indiana. I also host this podcast YouTube show with Matt every single week. Matt, thank you for keeping the lights on last week.
Kept it on for a little longer than usual.
Yeah, I heard it. That's what you said. But we had Addison, Lubert, and Katrina Green.
Mm-hmm.
Great multifamily experts.
Yeah.
Great capital all-stars. It was really interesting. Different scope. You're going to get different perspectives, very different perspectives from both of them.
From kind of the heads to the tails.
But so this week, back onto it, and everyone's a little more positive.
Yeah.
A lot more positive.
I think so. Yeah. And like, I feel like a dummy, but there is, recent PCE employment numbers. There's just like not the we gotta get another bank crisis coming here to dampen some people's enthusiasm.
It's the quiet dog days of summer. We've been pointing to some potential distress out there, and if that kind of hits ahead, it's not going to be until the fall, really October or November. So it was always going to be a quiet time, whether to the upside or the downside. Mm-hmm. But it really looks as though we're getting a lot of answers to the questions that we've been asking since March of where we've said, we need to get more data. We need to see how this is going to play out. We need to see how these interest rates, once they really start filtering in and really feeding into the real economy, what those effects are going to be on the investment market, especially in the labor market, and how things will normalize, or is something, going to break with almost an implied certainty that something will break.
Yeah.
And you could argue some things have broken or cracked, but it didn't necessarily bring down the whole ship, like the banking industry. We had SVB, we Signature Bank, we had that banking issue, like you said. Do we need something else? Is something else like that going to happen?
Yeah.
But now with the Federal Reserve, saying they're pausing for now, potentially 2 more rate hikes at some point. They're keeping some ammo ready to go. It's not saying that they're done.
Yeah.
But we're kind of more stable than we were a couple months ago. And people think that we may, again, get this kind of soft landing, or at least, touch and go. And it's not going to be the end of the world. Is that from your analysis? Is that what you're seeing, Matt?
Yeah. Yeah. I think they revised first quarter GDP up from a little while ago. There's just a lot of good signals now. There are some caveats, and
a lot of these lagging indicators that's like, it looks good now, but it always looks good before something.
Yeah, that's a good point. And I do think, though, as we think about soft landing or whatever, is there still is, as the specter of inflation hasn't gone away. And I think that the general thought is that the Fed is going to err on the side of caution, or at least err on the side of more rate hikes than less rate hikes.
Yeah.
As long as that's the sentiment, maybe that.
And if they get away with it, I mean, they haven't broken anything yet, so why not? You know, they've got the kind of flexibility. Bless you.
Yeah. I think that it is funny though that, like, you know, we've survived for this long. There hasn't been huge like the cost of food hasn't skyrocketed like it is. Perhaps maybe it was some of it the supply chain issues, and have they eased, or I don't know. I'd love to know the start and the end, or how much we're still, because I know in some construction jobs with like labor shortages that still may be persistent. I'm not really sure, but I don't think everything's moving like, you know, a well-oiled machine yet.
Yeah,
but I'd
true.
like to think that a lot of logistics problems are moving along more smoothly and making things a little cheaper than they used to be a year or two ago.
Yeah, I think that's the case, or at least the rate of growth has slowed down.
Yeah.
And, you know, it's not surprising that prices haven't like gone in reverse. I mean, that doesn't usually happen. You know, I mean, maybe a little bit of deflation if we had a recession, but if not, just that, you know, that rate of growth reduces, and really it's just been normalizing. And the surprise is that we, to many observers throughout the economy, is that things have normalized in a somewhat healthy and normal, orderly way without causing a crash.
Yeah.
And the chaotic nature of so much of this, I think it is, surprising people because of just the complexities of switching off the world economy and turning it back on. Not that we haven't had hiccups, like everything has gone just swimmingly. Inflation was, you know, one of the results, and, you know, inflation has, you know, reared its head and, you know, caused a pretty big wake, but it has not brought the economy crashing down.
Yeah. And it does seem like if there's any one unifying concern, it seems like inflation more than what I'm looking for is like the chink in the armor of the economy. And I'm sure that there are, you know, hundreds of economists right now looking for the equivalent, you know, whatever the great financial crisis, you know, mortgage-backed securities, those kind of things. Like, is there an area that's particularly vulnerable that's going to cause the domino effect? But like, they haven't found it yet.
No.
They have said sometimes, some people say, oh, you can watch out for the office market. But you'll see in this report, and even the Cushman report, that like it's going to be hard to push that over. And a lot harder to be as systemic.
And, you know, and we're going to look at some of some guidance on to, you know, the banking system on how to deal with distress, which was really interesting. But is it a situation where it's so obvious? Like, I don't know, I'm talking about the office market.
Yeah, I know.
Like it is so clear, the distress and the upcoming distress. And we can see it playing out over the next couple of months and years. And it's unlike multifamily, where, you know, the fundamentals are still really strong, or maybe even strong as ever. For where office, it's like it looks horrible from a, you know, capital markets standpoint, but it also looks horrible from a demand standpoint.
Yeah.
Just the deck is just stacked against it. It is what it is. Does that allow institutions, you know, individuals to make accommodations to figure it out if the rest of the economy is doing all right? Just like we've said relative to the multifamily, you know, loan maturities. If it's just pocketed, it can be absorbed. But if the office market is, you know, spiraling and the economy is spiraling, and the multifamily fundamentals may make sense, but like just the system can't hold much distress, and it's just going to take some of it down with it.
Yeah.
But if it's really everything else is just going off and everything is great, that will be an environment where liquidity exists.
Yeah,
and
it'll be
problems can be solved.
Yeah, it'll be an environment where there are losers, there are winners.
Oh yeah.
But it's not like everyone's a winner or everyone's a loser, which are where you should probably start worrying.
Yes.
And I was really struck by that. So there is a Moody's Analytics piece that we covered a couple weeks ago that talked about just how hard it would be to get to 40% devaluation in the office market.
Yeah.
And what I was struck was the occupancy numbers. Some of these occupancy numbers were actually a little higher than you think. People are still coming into the office. I still think that even a small persistent change in office demand is going to have a huge effect.
Well, I think it's the slow burn concern is that it's not like, oh, it's just this year it's bad. It's that as the leases roll over the next 5 to 7 to 10 years, are the decisions going to be made of like, we don't need as much office space. But then, businesses grow over the same period, new businesses.
And there are trends, I think. Well, and so to put a pin in the kind of office conversation, I think a lot is going to be dependent on how much leverage unemployment and employee leverage is going to be a big deal. And I also think that there are like cycles and trends. Maybe for a while at the beginning of the pandemic, everyone's like, yeah, come in, work from home. And then they realized that there were certain trade-offs. It's harder to communicate. I think productivity is still a wash. I think that there's still, I was talking about this before or earlier, like coordinated work from home may be a little bit easier or something, but it's not going to be all the same. Then all going back to the office.
No, are we experiencing or will we experience a snapback of like
that's what I'm back in the office? That's what I'm kind of. I don't think it's going to come all the way. Yeah.
No, and I think it's very different regionally also. I mean, conversations around the central Indiana. I mean, there are some folks that are working from home a lot more, or 100%. They just haven't gone back. Certainly the case.
Yep.
But the average conversation I'm having, and again, it's biased to folks in real estate and finance and insurance and stuff like that. Pretty much everyone's back in the office.
Yeah.
But then I hear folks like from New York, and they're like, "Oh yeah, I'm back in the office 2-3 days a week, maybe if that." And I don't see that as much here.
Yeah. And this is just the bigger stuff I was thinking about after speaking with Addison about all this. The younger people may be the ones that go to the office because they have less leverage than the older people that want to work from home and maybe have family and maybe more reasons to want to stay at home. But if that's the case, if that's what happens, then there is this generational gap where the younger people that you all know what the people around your age group know. Yeah. And there's less communication between the older folks and the younger folks, and you're really kind of siloed, not purposely, but like
translator.
Yeah, like the informal connections aren't,
and maybe that all makes sense. I mean, when you're younger and you're learning, you need to. Not everyone, but people learn hands-on and being in the group. I think it definitely is an environment and culture that fosters learning. And then does that then kind of build off a culture of then, well, all the young kids are here, we want to be that we want to be in the middle of it also, or is it a like, I've done that. Now I'm gonna serve my tenure.
I think as a responsible company, you should be pulling some of the old fogies into the office. Fogies, middle-aged.
No.
So to facilitate that kind of and
mentorship.
Coordinating is going to be probably the big name of the game.
A lot of it has to come down to leadership. I mean, if the bosses aren't going to come into the office, why would anyone else? Want to come in?
Yeah.
I mean, it's whether people admit it or not. I mean, that's just the case. It's like, well, hey, we don't have to. They don't see it as important. Well, let's hop in. Where do you want to go first? You want to talk about the Fed? Or you want to go into this?
Fed. I know you noted. I was like, yes, let's talk about it. So the Fed had, and you kind of put me onto this. The Fed has recently released a policy statement, an update actually, a policy statement on prudent commercial real estate loan accommodations and workouts.
And is this in the response to the report we put out recently, Matt, or just
your spin on it?
That was my spin on it, but maybe that's just a coincidence. As much as you want to believe in coincidence.
Yeah, just to summarize the reaction, that was Spencer's like, oh yeah, well obviously the
Federal Reserve reacts to Great Capital's recent report, which you can find at the Great Capital LLC.
That's true. We'll have to track see who downloaded it if we get a .gov.
Yeah, interesting. It has blown up though, so I'd check it out. I mean,
a
lot of people downloaded it last week. Anyway, Matt, so what are they figuring out? What is changing?
So,
and what are they foreseeing? Because this looks like it's like they're preparing to have the right tools in the toolbox.
Yeah, I think so, and then that's probably the best takeaway. Now, I will preface this by saying my takeaway was, oh, great, a statement on loan accommodations and workouts. Does that mean they're going to bail out? I mean, they're going to accommodate. They're going to make it easier for people that could have distressed property. Now, I said that's kind of annoying for everyone that's waiting for distressed properties to kind of activate the market and create a little bit more of a deal flow. But I don't think that there is much teeth to this, but it does kind of outline. I think this what your point is the best one here. Is it shows what they're thinking about, and they see it coming along, and it's not just multifamily.
And so just on the background, just the background of what we're talking about. So back in 2009, the agencies, so that's the Fannie Mae, just different types of government or quasi-governmental organizations, along with federal financial institutions, and some other organizations. They basically created a framework for how lenders can work out bad loans with borrowers.
Okay.
And so they put together basically a set of not rules but again guidelines of here's how we'd like to use if you're in this situation, here's how you can work out the problem so we can avoid economic calamity, to basically in a sense informally formalize the kind of extend and pretend avenue that we've been talking about, which is basically where, hey, we know right now you're underwater, upside down, things don't, but you're a good borrower. We don't want to take back the asset. As a bank, as a lender, I'm not in the asset management business. I don't know what to do. I don't have the team to have the conversation with the property manager every week and to replace the toilet. They're not tooled like that. So what are we going to do in different circumstances to accommodate if they can't accommodate?
Yeah, so it's better to give you a little bit more lenient terms, be a little less strict because you're in trouble, and that way they don't have to take it all back, and actually it's less expensive for them to be lenient in kind of these situations is the way that I kind of was understanding.
Because especially if it's a case where it's it's a good operator, it's a good borrower, it's just it's product of the circumstance and in the environment right now, and this is I think a very strong argument that could and is being made. Look, interest rates are high right now. We've had a bad year.
Yeah,
interest rates most likely, according to the Federal Reserve, everyone else, will be lower in a year or in a couple of years at some point.
Yeah.
Give us a little bit more time. Instead of the 12, 24 months, just give us the 36 or the 48. Give us a little bit more time. And maybe if we don't have the money to pay, just let's work on a payment plan that you agree to. We owe you $1 million a year. We're going to pay you $400,000 a year, and we'll make it back up. And it's there's some. It's not going to be free. They're going to have to be modifying the covenants of the loan docs. But just some framework that it's going to give the permission to these institutions when they find themselves in these situations, just what to do and what's okay. And also I think what the Federal Reserve, from their position as a banking system regulator, would like to see happen.
Okay. Yeah, I did highlight this passage so as kind of a difference between or an addition to the 2009 statement. And it says that consistent with safety and soundness standards, the final statement reaffirms two key principles. The first is that financial institutions that implement this loan accommodation after performing a review will not be subject to criticism for engaging in these efforts.
You shall not speak poorly
exactly.
of these institutions.
Well, it does seem like, there is an unstated expectation, like, okay, we're not going to come down on you maybe. But again, no real result of what might happen. Number two is that modified loans to borrowers who have the ability to repay their debts according to reasonable terms will not be subject to adverse classification solely because the value of underlying collateral has declined to an amount that is less than the outstanding loan balance.
So basically saying if you're underwater, the value has gone down, well, you're good.
I guess, well, I can see, that's the thing. That was why I was annoyed. It was like, the market could take care of it. Now, maybe the office market, if it's crazy crisis mode, that's another thing entirely. But for multifamily, there is like, it's hard to see people going and crashing and diving, crashing and burning and getting rescued.
Do you feel like sometimes the entire economy is like we're playing like bowling with the bumpers on? Sometimes like like no, we can't have, no one can get hurt.
We're waiting for gutter. Sometimes we need the gutter balls.
Yeah, right. Otherwise, you think you're great, and so you keep throwing it the same way. You don't have to improve your I'm not a bowler. Your toss, your throw.
And you know what I think, and this is it's a little bit of a poor analogy, but it is something that we have discussed in that, like, if these operators, and let's just use retail for an example. Let's say it's an operator who is not getting a lot of profit, but he's waiting. Leave that storefront open because he's going to get that higher wage, even though his building's not great. He's not, but guess what? He just got to work out on a loan, and so he doesn't have to fill it. He gets to continue to wait and continue to not use it as efficiently as he could, and you're still going to see that empty storefront.
It excuses and potentially encourages poor and malinvestment.
Yeah. So that
in the scale of hundreds of millions and billions of dollars.
Yeah. Now it will save people. People will be happier to have their loans worked out. That is, and like just in the same way that distress is going to be a tragedy for some people, but we got a plan for it, and we didn't need the federal government stepping in to address.
Well, there's a lot of just bad owners out. I mean, there's a lot of great owners, but there's a lot of bad owners. There's a lot of people who made decisions and took risks that they probably shouldn't have, and there should be losers, and there should be opportunities for new participants to come in and create opportunities and build wealth. But there'll be fewer of those opportunities because those that already, have the capital, who have misallocated the capital. Yeah. And because, capitalism, which we don't have, there's not real free market capitalism, but, it's a, system of like resource allocation, and, the market, it works off signals, and, prices are signals. There's different signals, but if the resource is, if we're rewarding major capital allocators for poor investment decisions and poor allocation, the system doesn't get any better.
Yeah.
It just can't work. Now we're solving to make everything comfortable and less volatility, to have less short-term pain, but does it create longer term systemic issues? And then again, people are complaining that you have bad landlords and people not taking care of their properties, and it's like, well, these people getting you sort of called it a bailout, and it sort of is a backdoor bailout in a way. It's you're not necessarily handing people money, but you are in a sense that the money that they are supposed to hand over, you're letting them keep.
Yeah,
so
saving them some.
And now we're not going to get into student loans, but I the same arguments that I would make against forgiving. No, these loans aren't being forgiven; they're just you're modifying the terms. But maybe they should have tried that for student loans. I don't know, but I'm just saying the argument of you're picking one group of people, one group of Americans, and prioritizing them, forgiving those loans. But it's like, but what about the guys that go into trade school? What about the people that didn't go to college and they tried hard, they started a business? Where's their check? Well, same thing with the same argument can be made here. What for the people you're going to modify loans for borrowers? Well, what about the office? What about the borrower of another business or something that doesn't qualify? Yeah. Or the person that couldn't buy it because they couldn't. There's a whole lot of groups out there that love to have their loans modified. Yeah. So, we're picking and choosing.
Yeah. I wonder, you could ChatGPT, change the language. Instead of CRE borrowers, we're talking about student borrowers.
Yeah. Interesting. Would be interesting. Yeah. So, man, I know it's 90 pages. That's why people come to the Gray Report. Any other takeaways?
The other thing that it did add was some examples on like page 75 or so of the report or publication. It has some multifamily examples. So here's a loan. This is how I summarized it to Spencer earlier. As it says, like, here's a loan. So and so is not making money on it, and it has devaluation of a property, and you give him a break this way. Here's another loan that's a bigger problem. Oh, you give him an even bigger break. There's not.
Yeah, this is great. Let's go. Okay, so which example is it, man?
Yeah, page 75. It starts
Okay,
with.
sorry. They've got a lot of examples, a lot of scenarios.
There's like it'll take one property, like a multifamily property, and it'll run it through, and a hotel one, or retail, or office. And I think they also have a single family one as well. But basically, yeah, there's no solution that says, oh yeah, you kick them to the curb. This is a kinder. These are kinder scenarios.
Yeah, I mean, my kids' baseball games, there's no outs.
Yeah, that's right.
And you think that, like, okay, well, when they're like 8 or 9, they'll start playing for real. But like, no, according to this guy, didn't see, there's no outs. There's, when we're
yeah. We'll give him a break. So
multifamily property, base case, take it, Matt.
Lender originated $6.4 million loan for a 25-unit apartment building. At maturity, the lender renewed the $5.9 million loan balance. Leases are typically 12-month terms with additional. So these are kind of typical stuff. 88% leased, but due to poor economic conditions, delinquencies have risen from 2 units to 8 units. 6 of the 8 units are 90 days past due, and these tenants are facing eviction. So this is the scenario. At maturity, the lender renewed the loan balance on principal and interest payments for 12 months at a market interest that provides for the incremental risk. Borrower had not been delinquent. Current financial meant the debt service coverage ratio is below 1. That means it's underwater, right? Yeah. So it's 80 or 0.80x because of the rent payment delinquency. Borrower projections show a return to. I'm sorry, I'm kind of skipping ahead here. A new appraisal has not been ordered. However, the lender noted in the file that if the borrower does not meet current projections within 6 months of booking the renewed loan, the lender will obtain a new appraisal. And I want you to tackle the classification.
So the lender internally graded the renewed loan as pass and is monitoring the credit. The examiner just agreed with the lender's analysis and classified the loan as substandard. So basically the lender is saying, we're not going to get an appraisal. It's all good. While the borrower and guarantor can cover the debt service shortfall in the near term using additional guarantor liquidity, basically saying that the guarantor is just going to come up with cash out of his own pocket.
Okay.
The duration of the support may be less than the lender anticipates if the leasing fails materialize as projected, saying, all right, you got some cash in the bank now. You can keep floating the loan, but you don't get these units leased up, you're going to be in a bad spot. You're not going to you're not going to be able to do it.
Seems reasonable.
And they may say, and I don't know if they said that they had to do this, basically you're going to have to add those like reserves. You got the cash, you're going to have to add in, drop it into escrow. Which they did during COVID. They had, they had big COVID, debt service escrows for most loans, and it made capitalizing a little bit more difficult. Economic conditions are poor and the rent reduction may not be enough to improve the property's performance. Lastly, the lender failed to obtain an updated collateral valuation, which represents an administrative weakness. It's non-accrual treatment. The lender maintained the loan is in accrual status. The borrower has, it means it's accruing.
It's a little bit more strict.
The borrower has demonstrated the ability to make regularly scheduled payments, and even with the decline in the borrower's credit worthiness, the borrower and guarantor appear to have sufficient cash resources to make these payments if projections are met and full repayment of principal and interest is expected. The examiner concurred with the lender's accrual treatment. So basically saying, come up with the cash.
Yeah. So there are other ones where they accept the debt on it's non-accrual. And basically, if the harder situation you're in, the more generous the potential workout is going to be.
Yeah, it is interesting. The worse you get, the more help you get, which, sort of makes sense.
It is nice.
Yeah. So, there's a framework for, assisting borrowers, borrowers out. Now, a lot of this, I assume, is going to be really directed towards, agencies, within the FHA, Fannie, Freddie, and HUD. But probably not going to be as applicable, although I'm sure that they'll use it as a guide to the bridge lenders and the debt fund folks, which a lot of the kind of the distress and the concern, is concentrated from those debt providers rather than the agencies. We always know, the agencies are really there to act as a stabilizing force in the housing market, kind of sort of be a lender of last resort, and kind of the door is always open.
Yeah.
There to accommodate really not there to. They're not really there to be a, maximize profit at all costs.
Okay.
They really shouldn't be by their charter. But bridge lenders and debt funds are a completely different animal, and so it's going to be what they can handle, what they can do, what they want to do, how they can make the most money.
Okay.
So it's gonna be interesting.
Yeah.
But I think that, I think if you've got an agency loan, you're probably going to be government sponsored entity guarantee. There's going to be some more stability for you and more options than if you'd gone with a private bridge lender or debt fund lender. Not that there aren't reasons to go that route in the right circumstance, but again, it's just during 2021, that was so many folks were closing with these bridge lenders and short-term debt, hoping to refinance later this year.
The parachute is for a little stronger if you had the agency, but some of the most endangered people don't have that parachute.
No, if you were, pedal to the metal, full on risk, you weren't going agency. People, weren't just ever, but like typically not. So Matt, where would you like to go to next?
You could kind of talk about this Cushman & Wakefield.
Yeah, let's go to that, the glide path report.
Yeah. So this is a useful review of the key, what it says is the key themes facing CRE capital markets when it comes to macroeconomy, credit, debt markers, and CRE flows. I've really dove into the credit and debt markets portion. Now they do have stuff on the macroeconomy, and I really like their comments. It's like, yeah, we've pushed back the recession a few times, haven't we? Like, I kind of agree.
Groundhog Day since 2019.
Yeah, exactly. And that they do say we're not quite there yet on inflation. There's some stickier parts of it, but consumer and labor markets show strength. And I do think that this is a really useful reminder. The correction in CRE started mid-2022. This is not the first inning. A rebound, they say a rebound's not far off. And, they finally kind of emphasize that the best time to buy property is when the Fed starts to cut rates. This tends to coincide with a bottoming and inflection in property values.
Yeah.
So we could be on the way up, and this is a lot more positive than some of the more pessimistic reports from CBRE last week and Fannie Mae, which is famously pessimistic.
Yeah.
But diving into the credit and debt markets. Oh, I'm sorry. The credit and debt markets portion, and this can actually be seen more in the report itself rather than this kind of overview. Yeah. But they say that credit will be tight through the end of 2023. They said pencil in gradual thawing in H1 2024. And also, and importantly, they have a whole section dedicated to alternative credit and financing that's going to kind of rise up to fill the void left by the bank's kind of more credit tight situation there. And all of these alternatives, whether it's mezzanine debt, preferred equity, senior debt, they're not going to be able to plug the gap perfectly, but it is very interesting to see. And they have a graph there that show people investing a whole lot more into the combined category of debt, distressed, and opportunistic. However, of these three, opportunistic takes the lion's share, and people who are looking for these vague opportunities. And then debt is the second biggest, and it's a sliver really of people that are looking for distressed as kind of at the exclusion to all else. Seems like it's this catch-all opportunistic.
Yeah, because everyone wants to be opportunistic. No one likes the idea of distress.
Yeah,
even though distress is where you can find the opportunity.
Anxiety and opportunity.
It seems because like an opportunistic, strategy could easily be focusing on distress.
Oh, that's what I was thinking. Like, what kind of opportunity? Yeah.
So I don't like those. I don't really like I don't like opportunistic and distress as like the categories.
I agree. Well, but we have seen this. We saw it in COVID. Yeah. Everyone's looking for opportunity. There were opportunities that came and went. That's another, and that got put like a bee in my bonnet about this idea of dry powder. And I'm continuing to ask this question. I'll have to ask a couple of experts because I was unable to just find it through research. How much of dry powder stays dry? How much circulation into and out of that category of dry powder is there? Or what it looks like, and I'm sure it's not the answer, it looks like these people are waiting for this opportunity to come, and it never quite does. But
I think it's a combination.
If you have a better target, if you have a specific target, you're not looking for just like a big, great thing to happen next year.
Are there inflows now? Is it is it revolving? Is there or you're saying is it piled up and truly on the sidelines?
Yeah,
I think typically it is revolving, but I think there's more to actually been piled up in cash recently.
Okay, yeah, that makes a lot more sense.
But it'd be an interesting study of when it's a lot of buying of treasuries. People staying in cash and they're probably buying 3 month, 6 month T-bills.
Yeah.
When those start maturing, people just repurchasing, those treasuries. Some people have been continued to, but on those kind of those periods where they're maturing, people are having to reassess their strategy in whether to stay in cash or to allocate.
Okay.
And I'm hearing more conversation, people moving away from cash now, saying like, look, get the 5% is great right now, but it's not going to be there forever. I need to start looking for other solutions.
Okay.
Long-term places to put the money because, in a year from now, maybe it's only going to be paying 3%, and maybe all the good opportunities have passed by that point in time. So people are looking to deploy, but to your question, I think there has been more actually just sitting in cash, not circulating, than in previous cycles.
Well, okay. That makes a little sense, and they also did talk about that as well in the context of these alternative financing sources and how what did it say? The issue here, if you scroll back, it's like in a footnote, it says the issue now becomes how many deals, business plans, etc., can stomach a largely floating rate index plus a spread that equals 2 and 8% plus coupon. Yeah, so it's not a whole big people will come up to meet the need for debt, but it's not like a bang on.
And that's what we've been saying. It's like, there's a lot of money that could be deployed. There's a lot of potential energy out there, but there's it's not just money for any deal.
Yeah.
They have to be good deals. They have to, have an appropriate premium on the risk. And, there's, a real risk-free rate now that we have.
Yeah.
And so I think investors, whether they're aware of that concept or not, are aware that they need to be paid a little more money than they have been.
Yeah.
And paying 8% interest doesn't make it easier to do on the deal side because people are saying, well, I'd rather be making, how do I get that 8%?
Yeah.
I'll just take that instead of the 12 with a question mark on it.
Yeah.
Maybe 12.
Yeah. And now, looming over this whole conversation and really kind of motivating all of this is the looming debt maturities. And it's something that you have commented on, and they talk about this specifically on, I think it's page 41 of the report. They say that there are multiple factors that are going to lead to a property being distressed. They pull out these 4 major factors, the diminution of underlying value, deteriorating cash flows, and this combined group of floating rate loans, bridge loans, oncoming loan maturities, and then finally constrained lending conditions. Now we need to make a note of the visual here.
Yeah, I was gonna say, you said 4, but there's a Venn diagram with 3 circles and then a line out the side.
So I don't know. So there are the 3 circles, the line out to the side. I don't know. So 3 circles are diminution of underlying value, lower cash flows, and floating rate loans. Those are the 3. Off to the side is constrained lending conditions.
So the Venn diagram is more like internal factors to the deal, and the constrained loaning conditions are like external factors.
I think that's what it is. So each of those circles, and then the environment. That's the whole.
Can you think of it? I'm thinking of a better way that this could have been visualized, like they could have had a square. When they had the Venn diagrams, and then they had a square with use the area around the square as the.
So I have an even hotter take.
Okay.
So it's a glide.
How you would design.
Yeah, exactly. This is what I was doing all this morning.
Perfect. A lot of good work.
It's along the lines.
July.
Yeah, that's right. This is a glide path report, and why not make this kind of a linear path? It starts with deteriorating values, and then we go to, deteriorating cash flows. It starts with deteriorating cash flows, and then you get to diminution of underlying value, and then you go into your deadline of floating rate loans and bridge loans.
But does the floating rate loan bring upon the diminution?
It's a combination
of the interest rate. Yeah. Anywhere in this report, Matt, so it's called the glide path report. Is there any good analogies, metaphors, visuals related to glide paths?
I do think on the actual the tab, not the report itself necessarily.
The tab,
they have a summary website for the report. If you scroll up, they have like a little visualization that shows like this timeline. And then it is worth noting here that one of their timelines concerns the length of time in which CRE and loan maturities will remain an issue, and they say it's about the next 7 years. We're going to be making decisions.
I believe that. Yeah, I believe that. I still don't see the glide path visualization that I'd like to see.
Well, there's a little bit of a glide, like as it fades into and out of each event on this timeline. I'm giving them the benefit of the doubt. I really did,
It's like a Gantt chart, and that was what this is.
I'm not up to speed on on nomenclature for I know line graph.
Mm-hmm.
I know
glide. It's not glide
and bar. Those are like the three. Oh, scatter plot.
Scatter plot's good.
Yeah.
Anyway, that's why you come here for the information, but you stay for the critique on the visualization of the report.
And they had multiple takeaways that we have kind of repeated here. One, when it comes to loan maturities, is one, it's not going to be uniform. It's not going to infect the whole market necessarily. Pockets of distress. And they repeat the greater demand for alternative forms of financing. The 7 year, the kind of 7 year span of time, and ultimately they say that, and you're gonna have to parse this for me. They say that significant opportunity exists to optimize stressed and distressed assets and portfolios in response to changing market conditions. This applies to multiple points within an asset portfolio lifecycle, all as it applies to both asset management and capital debt market opportunities. Get out.
So what does that mean?
I think it says, get out there. Let's start trading.
Yeah, it does mean get out there, and sometimes these assets need to be recapitalized, and I think that's partially what they're going for, is that it needs a new little life cycle, need a new fresh blood and fresh energy. And a lot of times, what happens is an owner goes into these deals and they've got all these great plans, and they do the plan, but they bring in enough money to do the big thing. If typically it's a value add or something, we're gonna fix some things up. So you bring on the money to fix it up, then you spend that money. And then you're setting aside money for CapEx, but it's more of like maintaining. You're not necessarily bringing on like a lot of money to like renovate the whole property. You usually have to bring on funding, whether through debt or equity, to do that. And there's a lot of assets that like, it's a good deal, but it needs another $1 million. Yeah. These guys are out of cash, and they're barely making any money right now. But like this thing could be great, but it needs an injection. And so I think that's what they're getting at, is that there's going to be different opportunities for different assets in their life cycle. It could be a developer is just delivering a new development, but they thought they were paying 3 to 4% on their interest rate for their construction loan. Now they're paying 8%, and so they've gone through all their cash, and they just need to sell it. And maybe that they've leased it up at lower rents because there was low demand for a certain period. And so then there's a new owner just needs to come in and just operate it in different context.
Yes, cut it loose. I think that there is
a lot of cutting loose.
There needs, you can't reel it in. You just have to save your future money that you would have spent on it. And I wonder if that's what it is. It's like, listen, if you're looking at this distress deadline that's coming up, stop pretending you're going to save money in the long run. If you come to this realization sooner than later.
I was going to say sooner rather than later, because they're not putting their best effort to it.
Yeah.
Just quick story. So I was good about 30 miles or so off the coast of Key West. So 60 miles away from Cuba, and we were fishing. And I hooked up this big fish, and it was fighting for about 25 minutes. I'm getting tired, but I'm like, I'm fighting. I'm like, this thing's coming on the boat.
Yeah.
This is what I'm out here for. And get a little closer, start seeing some color. And long story short, it's this big shark, big lump shark, which is cool. But, if you've done enough fishing, you've caught enough sharks, and like, it's cool to catch a big shark. It's a big fight, but you're not eating the shark, and you got to have to deal with unhooking it. And it's a little bit of it can be a thing, but it's still fun. But I see the shark, and it's like, it's not something I'm going to bring home and eat. Not something I'm going to bring on the boat.
Yeah.
And I'm like, oh, sooner we get this thing off the line, probably the better.
Yeah.
And I all of a sudden am not as motivated in
Mm-hmm.
this fight. I mean, I'm still having fun.
Yeah.
But I care just a little bit less.
Yep.
Because I need to get it off. And then a couple of minutes later, it kind of swims, it's getting much closer. It swims under the boat.
Mm-hmm.
Basically, probably 10 feet away from, landing it.
Yeah.
It goes into the boat and the line snaps.
Perfect. There you go. All right. Yeah. Yeah.
So I was like, very tired. I'm happy to be done.
Yeah. Yeah.
And I think these owners it's the same thing. It's like, it isn't going anywhere.
Yeah.
Like there's no meat. There's no dinner we're bringing home.
Mm-hmm.
Sooner the better.
Yeah. Changing plans. And, maybe don't talk about it like a failure. Just say, listen, things are plans have changed.
Excited for the new owners.
That's right. That's right.
Great property. Great stuff. All right, Matt. Where are we up to?
Into multifamily specific. Actually, if you want, I'd like to do some Spencer Gray specific stuff. There were a couple articles released, published last week, just at the tail end that I wanted to bring in here. And now we've talked about the report that we've done on multifamily loan maturities. We just finished talking about them in kind of a broader context. And both The Real Deal and BizNow have published two separate articles on this issue on our report. And Spencer Gray and I saw some wonderful.
So there's my face is on the Real Deal article, but it's actually should be probably Matt's.
No, I don't know. I like that picture.
They did a good job. It's my LinkedIn profile picture. They do a good job of the stylized photos. Anyway, yeah, I had a pleasure, talking with the folks Real Deal and BizNow about the report that we put together, Matt, that you really spearheaded, the report on upcoming loan maturities, and potential distress in the multifamily market. You can find on our website, greatcapitalllc.com. But, we put this out really just because of finding data points in the market and saying we should really consolidate this information in our analysis after looking at it and doing every single week and all the time. And I think they put together a really good summary of what we are seeing, our perspective, and some of the ramifications. And it was cool that, and I think both humbled that they took our perspective and our take and our analysis and, thought it was worthy to put it out there. And in BizNow, not only did they cover the article itself, but they also have been using it as a data point for some other articles, specifically on a story that we've been covering on the Tides Equity portfolio, just, kind of massive portfolio in the Sun Belt, a lot in Phoenix, and other Sun Belt markets that has just put out a statement that they may be issuing capital calls relative to all of their multifamily portfolio. Yeah. And so the BizNow used our report kind of as a reference point in that piece as well. And so we were swamped. I think it was Friday when these pieces came out. I mean, I don't know if it crashed the servers, but I mean, we were, I think it was our biggest day of traffic match ever, that especially from like organic traffic. It was pretty incredible. I had a meeting with Blake this morning. He was floored about the interest. So if you haven't checked it out, go take a look. Again, you can find the original report, greatcapitalllc.com, but then take a look at the Real Deal and BizNow articles as well to just get just a little bit of perspective.
The link in the show notes.
Yeah.
Links, sorry.
Yeah.
It was interesting, and one of the things that we did with this report, and I think which is still relevant and maybe even more relevant as we approach the date of these loan maturities is, we want to find out when does something's happening as precisely as possible. And a lot of information that we've received over loan maturities has say like, oh yeah, like the Cushman report said, oh yeah, over the next 7 years, we're going to see elevated. But what month? If we're talking about opportunities, if we're talking about things that may, pop up and are not going to be systemic, then you're going to want to know, if it's going to happen tomorrow or next week.
Yeah. That was I think why they were they were interested in knowing two things, like when and like how we knew when. Yeah. And the exact number. And I think the exact number, so, they could make sure they could drill down to it in the article itself, but it was and it was our intention of like, hey, look, we're going to put a little bit more specificity on, when that, kind of that max Q period, the maximum pressure, may be, or when it could begin. And in that the graph in the report, starting in October, visually tells the whole story.
Yeah,
and they saw it the same way we did. And I think it's useful as a data point, and that's where we say, look around and everything doesn't look that bad, but we're like, but it's not. If it's going to get bad, it's not supposed to get bad until October.
Yeah, and if you look at the loans that were reported to be maturing through the Cushman report, they have 2024 as there's going to be elevated loan maturities too. And if you think about it, 2024, some of the loans that were made in from January to 100%. June of 2022, those are still on deck.
Yeah,
and so there's going to be increased opportunities. What I think will happen is, maybe it's like tight equity, maybe it's like that Apple Way investments, maybe it's this complete implosion. I don't think that's going to happen. What is more likely is that it will just reorient people's logic, reorient their spreadsheets that they're bringing in, and make them a little bit more, make a lower price, selling for a lower price, more palatable.
Yeah,
and that's going to have a net effect.
I can see just being market a little soft, areas of strength. But, some big players are going to be focused on dealing with some of those issues. Mm-hmm. Less market participants just means less transactions, less buyers.
Oh, really? Okay.
Prices maybe not be bid up.
You think that this is going to mean that the distress is going to throw a significant amount of people out of the market?
So let's just take Tides Equities as an example. I don't know those guys at all. So this could be completely incorrect speculation. But if they're in the middle of capital calls and they're in the middle of a handful of distressed deals, maybe they're not going to be doing as many deals. Maybe they've done like billion, like they've done a lot of deals in the last couple of years, like a lot. So they could be the rock stars that they seem like they might be, and they handle this with grace and get out of it. It's coming unscathed, and they raise all the money for the capital calls, and they raise more money for new acquisitions. That could be true. But I see it adding resistance to the market.
Yeah. All things being equal.
All things being equal, I see a little bit softer. And people are going to be delayed too. They're not going to be convinced that the market is great just yet.
Yeah.
And because we're getting a lot of different pieces of information. This week, everything is good. Everything's great. I was listening to, I think, a Goldman Sachs, their forecast. They've updated. They've got an interesting they do like a podcast of their economic forecast. It's kind of interesting. I think they've reduced their chance of probability of recession down to 25% over the next 12 months. The market consensus of forecasts, is the average forecast, is still having it at a 60%. And that's been unchanged since the fall. So the consensus is we just not going to make any changes on what we think.
Yep.
But I think some of the folks that are looking at it a little bit more at a higher frequency, which there can be downsides to that. But are saying that, it's down to 25%. Do you remember when it was 100? We're talking probably different forecasts.
Yeah.
But there were a lot of forecasts calling for 100, and we made fun of it at the time, absolute certainty for anything.
Yeah.
We were like, well, we certainly won't happen then, right?
Yeah, that's right.
You got to 100, okay, so it's not happening. And things look good right now, but not everyone's going to believe that for a while. And we've talked about this before, but especially going into an election season.
Yeah, that's a good point.
Everything is going to get. It becomes, the reality matters not. It literally will just be what sort of political side of the aisle you subscribe to, sort of.
Yeah. It is heartening to see. I continue to go back at this. There is got to be an opportunity cost for listening to for holding a more pessimistic view of an economy that doesn't come true.
Yeah.
So, and I don't want to say people are irresponsible, but I will say that it's easier to get clicks if you have a mushroom cloud in the background and you're saying disaster, which is what people have been doing for the last 6 months, and it hasn't happened. And you'll get clicks and get attention. doesn't need to be there.
I mean, Peter Schiff's been doing it since before the last great well, really, he turned it up after the great financial crisis. And then, he went a whole cycle, an ongoing of being, it's going to crash and, and it's always
sound like
next 6 months, and he's investing in, he's in the gold business, and gold hasn't really done, it did all right for a while, but hasn't been the save your investment that, he's been talking about it because of hyperinflation and all of that. Some of the underlying reasons for investing in gold are similar for apartments. It's different in a lot of different ways. But he seems to be still, we should have Peter Schiff on the show and not talk about, economic, we'd have to, but more talk about, the business, the doom and gloom, strategy.
Yeah.
And he'll probably say it's not doom and gloom. I'm just telling you what I see, and I'm just talking about economics, and it is what it is. But your question, Matt, what's the opportunity cost of making doomsday scenarios and then not coming true?
Yeah.
The guy doesn't seem like he's paid much.
Yeah.
Cost.
Does he invest it all, or is he all keeping it?
Is he buying it all gold, or that's a good question. And he's not even that big into crypto, which he could have been, but he was in the he was plugging gold, so he missed that train. I don't know. I think he lives in Puerto Rico now.
Well, and all of this kind of includes the fact is we are actually at a moment in the economy, I think, and in rent growth, multifamily market, housing, whatever, where it's going to pay to pay attention to what things are happening month to month. Year over year is going to give you a really weird skew. And just kind of noting this apartment list, their multifamily report shows 0 year over year rent growth, and it's probably going to get worse. But if you look at it over month to month, you get a different picture, and things are so weird.
Yeah, but in the past years. Exactly that year over year versus month over month. Because if it goes way up and then goes way down and then it goes up, but you still haven't gotten back to where it was the year before.
Yeah,
it's no, we're trending the right way. Now you could say where does that trend end? And then you can figure out higher highs or lower lows.
Yeah.
But you have to know both where we were, where are we right now. But then, what does the fundamentals tell you of the next 10 years? Because if for anything like today, if you don't have a long-term perspective, I think you could get into trouble in it. But if you can take a long-term perspective, if you have the fortune, so not everyone has that fortune. A lot of people have to have a higher velocity. I need to flip it. I need to make the money this year, in the next 2 years.
Mm-hmm.
But if you have 5 years, 10 years. We're looking at a deal right now, Matt, and we know about it, or you know of it.
I know about it.
Could be a 15, 20-year hold.
Yeah.
We're going to look at it 10, but it seriously could be I know
cash flow.
5, it's going to be a cash flow play. It's going to be it could be an everything play, but it's an appropriate to have a long-term vision.
Yeah. I completely agree. Long-term vision, when the market's shifting, pay a little bit attention to the short term, because if you want to make acquisitions and you want to look for the right market, in this apartment list report, and if you want to pull it up, but it shows the regions, and there were 2 things. The first thing that I wanted to distinguish was month over month versus year over year. Now, we talked about that last week when there were so many mixed signal headlines about home price growth.
I enjoyed that.
The same, and you can kind of say the same thing a little bit about rent growth in 2023. Now, the story of month over month rent growth is a little bit lower than the historical averages, but still positive. The story of year over year, and the chart will show you, is a plunging down to flat. We're at 0 rent growth. It's not that rents are 0. We're not giving away free rent, but it's not increasing in price. And that compares to it says May 2023. I don't know what the red and blue numbers are here.
May 23. That's just monthly growth.
Oh, okay.
Right.
Oh, the top. Inflation.
CPI top line inflation. Yeah. And then the blue is rent of primary residence, and then the purple is the purple.
Oh yeah. Okay. So this is their. They are also saying that CPI rents are heading down finally, and they're going to start pulling things out. But the most dramatic line is they've huge peak of rent growth that was in 2022. And right now we are plunging down. We have plunged into zero and may go in terms of year-over-year basis, may go in the negative.
But again, so you can look at this graph and say we have 0% rent growth right now.
Yeah.
But it's not necessarily the case.
Yeah. And that is also true if you scroll. So if you scroll down the month over month, they show positive rent growth for every month except for January of this year. Now, again, slightly lower than 2018 and 2019, which is the pre-pandemic years. But my final thing, so we've got the difference between year-over-year, month-over-month. Final thing is regional variation. It is readily apparent that the story of this year, 2023 rent growth, is the popular Sunbelt markets are cooling off and taking the whole nation's average with it. And what did they say? That 73 of the nation's 100 cities have rents that are decreasing. A lot of those, among those 73, are not a lot of Midwestern markets.
Yeah.
And so,
why don't they have their interactive? They usually have their Tableau interactive maps. What's going on?
We'll have to talk to Ivan about it.
Yeah. What's
I don't know. That is it's a little disappointing. We'll have to see what maybe there's some kind of flash.
Usually they have really nice Tableau powered interactive charts where I get to hover on these cities and it would tell me exactly the rent growth.
It's just an image this time, but they did provide a little bit of extra charts this month with the comparison to CPI.
That's great. Look at this though. The Sun Belt, which has been the darling and has been the kind of the consensus play, Matt, is having rent declines across the board,
except for Miami,
except for Miami, except for South Florida. South Florida. It's like the Midwest and the South Florida is just keep chugging along.
One thing that kind of unites them is, well, first of all, is supply. The markets that it's almost like after 2022. Markets suddenly became a lot more vulnerable or began to be more vulnerable to supply influx. But all these popular Sunbelt got dumped with new supply.
Yeah.
So that's one thing that is triggering this cool down in the formerly popular markets. The second thing is, I think cost of living is a huge thing.
Yeah.
Midwestern markets are low cost of living and on a relative basis, there's a lot of Miami that has lower cost of living than you would think.
Yeah.
So that I think that those are two factors that, you'll probably see Midwestern rents coming up a little bit slower. It's not going to be perfect. They're not going to come up all the way to the Sunbelt rents, but they are.
My concern, man, is it's going to be tough to buy maybe in the Midwest, and we'll see as more deals come on the market. But if the competition picks up and those cap rates compress, there may be a kind of a brief opportunity to get in the Midwest, and we may even start looking more Sunbelt markets if folks are not as active in some of those markets. But it really emphasizes that you can't overly simplify any narrative or investment thesis.
Yeah.
And I'm talking about investing in the Sun Belt with the idea that, that's where most of the migration is coming. People are moving down there.
And they are.
And they are.
Yeah.
And again, over the long term, that supply will be absorbed. I think a lot of it actually is being absorbed.
Mm-hmm.
But and it goes to show that you can be right on one thing, but still the timing is hard to figure out, and you can be wrong in the short term. You could have said, I'm going to invest in Houston or Atlanta or Memphis or Charlotte or any of these markets, in Las Vegas, and I'm going to do a deep value add.
Mm-hmm.
And it's a good market for the next 10 years. And over the next 50 years, it's going to be a great market. It's going to have great growth. But you picked the 2 years where it didn't work. And the musical chairs, the music stopped.
And that's, and I think that's why it's no coincidence that the dramatic stories about loan maturities that we're seeing are coming up in Sunbelt markets.
Yeah.
Markets that have had all at once, rising expenses, all at once, new supply, all at once. Here comes the higher loan, higher costs for lending, and thank goodness that some people are kind of realizing soon now. I think it's going to hit people too late though for many.
Too many people took the get rich quick approach versus get rich for sure over a period of time.
Yeah. And so even just a little bit further into the apartment list is, they talk about nation's largest cities with negative rent growth. I'm really more interested in their ranking of markets that they have, the fastest winners and fastest losers. The slowest metro level rent growth are some of these popular, Salt Lake City, not necessarily Sunbelt, but it definitely was one of those kind of destination remote working paradises. You can go for a hike, go take in the nice aspen trees. And Austin too had one of the largest influx of supply, and it was also one of those, Phoenix, Portland, and over the last 12 months, New Orleans, Vegas, Phoenix, Austin, Sacramento. These are sunny places, and they're not seeing.
But Matt, again, even on the on the 3-year, there's a couple Midwest options. I mean, Minneapolis, which has had a lot of its own unique issues, but in general, on this list, I'm really only seeing, Midwest, Milwaukee.
19% over 3 years is pretty nice, though.
Yeah, I was going to say that's 19% over the last 3 years.
Yeah.
I keep thinking back to this about this one individual I met, Matt, and this was in 2019. It's in California. I was in Napa Valley at an investment conference, and they were a multifamily shop, and we were talking, and I was telling them basically how the Midwest was mispriced and a good opportunity. And their entire thesis was basically that the center of the country was basically going to just continue to be hollowed out, continue to rust out. Because why would anyone be there?
Yeah.
And just everyone would just keep moving to the coasts and Silicon Valley.
Yeah.
And so they were just going to be building in those markets.
I don't agree.
And he was like, that's our entire thesis. And I'm like, man, I could not have embodied a more sense of coastal elitism and arrogance.
Yeah.
And it's I'm not even getting an argument with you friend, because you're going down that road. You've gone down that road.
Yeah.
But I think about him a lot.
Yeah. Well, you know what? If they did all pour to make things awful crowded. And I think about crowded national parks and stuff.
Yeah.
And people like crowds, and people like space. Guess what? There's a lot of space.
Yeah.
In the Midwest, there's reasons beyond. I think even beyond the fact that lower cost of living, I think you get a little more space, and that's something that's happened in the remote work world. Is people want more space, whether it's apartment square footage or even, dare I say, a yard.
Yeah.
I don't think is as accessible in the East Coast.
Well, it can be just how much you want to pay for it, especially out west, on the West Coast. And again, so we're not, this is not over a short, because people say, well, the Midwest, it's just kind of steady Eddie. You don't see really any growth, but now everything has dropped down, so they look like they're strong.
Mm-hmm.
Over the last 3 years, again, San Francisco is the worst. Minneapolis is second. But again, Minneapolis has had a lot of its own issues that really aren't related to anything other than Minneapolis.
Mm-hmm.
Then it's San Jose, so to California, which is, they're not too far away. Washington, I guess that's DC, New Orleans, Seattle, Pittsburgh, Houston, Portland. Man, I'm seeing a lot of coastal.
Yep.
I'm seeing a lot of coast. There's 2 in the Midwest.
Yep.
Now, fastest rent growth. Let's look at this, going the other direction. Now, over the past over the last couple of years, it's a good mix. There's some coastal, there's some Sunbelt. Grand Rapids is in there. I guess that's the only Midwest. Now, over the last 12 months, Indianapolis is in the list. Kansas City, Chicago, Cincinnati, St. Louis. The last year, Matt, this is almost all Midwest, albeit, a New York, a Boston, and Tucson.
Yeah.
Tucson's crushing it.
Yeah. If we're looking over either the past 6 months or the past 12 months, there is nary a Sunbelt.
Yeah, there are. Yeah, I was gonna say. Raleigh. San Diego is
the farthest
Sunbelt.
The farthest south that you
Orlando. Get. Tampa. It's got all these past 3 years. Yeah, for the last 12 months. Yeah, there's not a one.
Now Pittsburgh, maybe Louisville. Louisville's the farthest south that you get.
Yeah, it doesn't count. Not our backyard. She's ours. We
So,
claimed.
no, I think that Kentucky's a part of the Midwest.
It's not part of the South.
It's not. Yeah, you cross into
Tennessee.
Mason
Dixon line is a straight line.
We're claiming that first.
Yeah.
Kentucky.
Mm-hmm.
Anyways, I do think that is because a lot of the rent growth story of 2020, later 2022 and 2023 is tied up in the strong supply. That's why. Oh, there's our chart. Well,
sorry, I need to share my screen. Yeah, they do have their fancy graph down here.
Yeah, but anyways, all that regionality is supply is a regional thing, and what it kind of suggests, I think, is that there are strong fundamentals behind it. Not everything's sinking uniformly, and because you can at least nominally draw cause and effect on, okay, this got a lot of apartments, there's a little bit more vacancy here. It suggests, I think, that it's not quite so dismal. You just have to figure out which markets are going to get a lot of apartments, or which markets have a longer term vision that aligns with what you have, maybe a 5-year plan. So if you're looking beyond that, then I think you're fine. Like what you said earlier.
Yeah, you have to have the full picture, and if you just look at demand, you're only looking at half of it.
Mm-hmm.
It's what that balance is, and then what no one can predict the future. And real estate is hyperlocal. We talk about things at a national level because there are national trends that happen that are correlated, but then there's also local trends and local stories that can supersede and interact in different ways. And it's best to be an expert in your markets and to find the things that don't show up in the data, because that's the other thing is the data, while we try to get granular, it's an incomplete, we're looking at digital pictures.
Yeah.
And to get the true analog, you have to aggregate and consolidate and you got to use your brain.
Yeah.
And physically be there most of the time.
Yep.
So you always keep that in mind. Just real estate is always so hyper local. But we try to correlate and see what trends are. And I find it amazing. What I do a lot, I'll see here national report and I'll see if it's picking up, and I'll look at our data.
Mm-hmm.
Then I talk to other apartment owners and to see if they're seeing similar things. And sometimes do it the opposite. I see things that are going on in our portfolio, and then I ask different owners if they're seeing similar things, and then does it correspond with the data? And a lot of times it does, especially in demand. It's like, man, we had a really slow couple of weeks. Then all of a sudden it's like national, demand is slowed down, or like, man, we're crushing it.
Yeah.
You're reading articles, it's like, it's slow, but man, we're crushing it. And then an article comes out, things have picked up.
Yeah. And
so, they're anecdotes that you can't weight too heavily on, but it is amazing some of the national regional trends that do exist and that correlate, and sometimes they go the opposite direction.
Yeah.
When Indy was still growing but the rest of the country was declining.
Mm-hmm. Heck, if logistics is picking up, maybe there's a sub-market that'll benefit from it.
Exactly. Matt, incredible.
I know. You all the time on vacation, I was planning on an audio return with more and more stuff to talk about.
There's more. There's more we didn't even get into.
Yeah, that's true.
There's so much that's jam-packed, man, on the Gray Report.
You got it.
Every Thursday, we send out a newsletter. It's called the Gray Report. You can sign up at graycapitalllc.com/report. No, that's the loan maturities report. /newsletter.
Yep.
Either way, graycapitalllc.com. You'll find it, whatever you're looking for. But every single Thursday, Matt, this thing is jam-packed, full of way more reports and articles than we talk about on a weekly basis. And the people who read the newsletter are major decision makers in the industry.
Agreed.
I mean, we see who's reading it, and it's not necessarily like investors are reading it, but it's the industry insiders. They're coming to the Gray Report to give that information. And
I know I've said this before or something like it, but like we don't try to dumb things down in the report.
Yeah.
I think that's why the industry insiders like it. Yeah. But also I think that there's plenty of stuff that's available that's accessible to people that are just getting started and to people that are really seasoned. Yeah. The information is out there. A lot of times it's just finding the right information, and that's what we're trying to provide people.
Yeah, the truth is out there.
Digging, we'll do it for you.
Truth's out there.
That's right.
I want to believe.
We've got truths out there, and we have it.
Yeah. All right. Thank you for watching The Great Report. Make sure you're subscribed to the Great Capital YouTube channel. You're tied into wherever you get your podcasts. Make sure you're subscribed, however that works. Leave a comment below. I think it was 2 weeks ago we went through comments, we read them on air. Bring it on. Say you guys are not intelligent.
Yeah.
That'd be good. Or I don't know. Let's be more specific than that.
Make a personal comment that it suddenly gets in my subconscious and it's like starts. Then I'm going to be like rethinking. Maybe I stutter too much or something. That'll be
yeah. Really, some like psychological.
Exactly.
Throwing us off. Then we'll do it, and we'll have not read them. Be like, oh man,
I blink too much.
Yeah, Matt needs to like do his hair or something. That's right. Matt'll be. You'll see the rest of the episode being like,
you told me about it. Yeah. That's good.
But read the comments, check out the report, check out the newsletter. If you're a credit investor, we'd love to have a conversation with you. We're looking around, trying to find something that makes sense, but we're not just doing deals to do deals. Just trying to be smart about it. That's why we started doing this podcast in the first place, Matt. Let's just figure it out. All right. See you soon on the next episode of Great Report.